One thing about geopolitical uncertainty and just uncertainty in general, it always exists. It's just a matter of whether the market marginalizes it or not. If you go back the last 4 decades and you see spikes in uncertainties and so forth, you see the Gulf War in the early 90s, you see the 9/11 event, you take a look at what's happened here recently. We've had spikes of uncertainty and geopolitical tensions, much more so than we saw in the previous, 35 years. And then look here recently. So it's one of those things we have to kind of understand that uncertainty always exists. It's just a matter of we're ignoring it or if we're over amplifying it. So it tends to make a investor, whether institutional and or retail, kind of get to a binary phase where when things are bad, you get catastrophizing on every scenario. When things are good, everything's euphoric. Somewhere along the way, being lucid on that standpoint actually creates where the opportunities come and it looks to exist. And again, when you look at the oil shocks, that's been really existing. Even going back to 1974, there's been 11 shocks in oil supply shocks, big significant price movements going back in this. And so when you look at the recent events in Iran and the Middle East tensions, there are some nuances to it. And I think that the one thing is to not extrapolate the negativity or even the positivity in this, because as Cliff was talking about, we have an environment where we just don't have escape velocity in a lot of things. We have a lot more positive than negative. So when things kind of flare up, we can kind of tend to say, oh, the world is burning and so forth. Yet when you look back in those times, those are actually when you get great opportunities. And in fact, actually looking at some studies on this, not only here in the United States, but when you see these events, it was a JP Morgan study, 12 months after the average return in the S&P 500 was 14%. You saw similar returns over in Europe as well. So these create great opportunities, but it doesn't mean it's the bottom. And in this particular case, this event, this geopolitical tension that's risen here recently, isn't something that's just happened here in the last 5 years. This has been kind of nurtured and so forth for over 45 years since Iran and the regime change that went back in the late 1970s. So when you have a long duration of these kind of things, they don't get settled right away. So what we would argue is that you might get stuck with a headline like everything's good, we have a ceasefire, we have an end of the war. Nope, everything's going to go worse. Now we're escalating and so forth. It really works itself out. The water will kind of find its level. And so when we look at the opportunities, we've been big proponents on international, and international was gaining favor even before this. And so many times, how you come into a situation and these skirmishes and so forth is often how you come out of it. And so when we look at it, we're not only looking at international emerging markets and so forth, and a chance at maybe some piece with some kind of durability to it. But coming back here, when we talk about quality, is look at the CEO guidance, look at the earnings expectations, look at the flushness of cash out there. 7.9 trillion ICI money market funds. Fund managers now are elevating cash levels at high levels. You look at retail investors now because they've gotten hit with this, they've gone into elevated cash levels. These are all good signs that the bottom is near. Maybe it's not here and now, but it is not near. But don't get caught up in the headlines because it will change the next tweet that comes out from President Trump about this, and then trying to corroborate the information. So kind of keep that little longer term time frame. And I do like the idea of the income side of it. When you look at volatility in the equities and so forth, that having good quality, intermediate duration, high coupons, when you have a tethered interest rate environment, where it's kind of saying rates are going a little bit up or a little bit down. You find an interest rate scenario where in inflation, where you kind of see maybe it's a little bit steady. So the higher the coupon, the better the overall return, the higher the potential dividend that's coming from these companies or BDCs or any of these companies. That's going to prove to bear out, especially over the next year to 2 years.
Yeah, I think I'd just add, yeah, sorry, Cliff, just the two-sided risks really we see in the market, right? Obviously, the conflict could drag on, and you likely continue to see risk assets sell off. Now, on the other hand, you could see signs of de-escalation, and what we've seen already is that things can snap back very quickly. So the point that we've been making is that good days can happen in bad markets. In fact, the best days in the market frequently happen during corrections or bear markets. And if you miss those volatile, high return days, it can drastically impact your long-term performance. So as Matt was saying, I think the key is to stay patient, continue to think long-term, look through the geopolitical noise. And I think it's important to note that despite the volatility, we're focused on fundamentals, and those fundamentals are actually improving. You're seeing earnings growth estimates that are accelerating for the domestic equity market. Despite the war, you're going to see earnings growth double digits in 2026 and double digits in 2027. And because equity markets have essentially been pretty range bound through the first 3 months of the year, we're seeing valuations that are the lowest that they've been in over 2 years. You've got the S&P 500 that's trading below 20 times earnings. We haven't seen those levels again in about 2 years. So ultimately, the fundamentals still look solid, and that could be a good thing for investors.
And the only thing I would just reemphasize, and you two guys hit it, is it's super hard to time any market, much less this market, because you're a tweet away from being wrong way in terms of the position if you're looking at it too short term. So you have to look through this, but be smart about it, right? The cone of outcomes is very wide. And I think the playbook that Matt and Jake just described here is built to kind of narrow what the outcome is that you're trying to produce. While, obviously an era of volatility could be wild swings here. So again, just looking through with very prudent and smart allocations should help produce good returns given our outlook and less volatility.